Investing in the stock market can seem daunting. There's so much to learn. One of the most important tools for any investor is the balance sheet. Don't worry, it's not as complicated as it sounds. The balance sheet is basically a snapshot of a company's financial health at a specific point in time. It shows what a company owns, assets, what it owes, liabilities, and the difference between the two, which represents the owner's stake, equity. The balance sheet is based on a simple equation: assets equals liabilities plus equity. This equation must always be balanced. That means everything a company owns must be financed either by debt or by shareholder investment. Think of it like buying a house. The price of the house is the asset. You might take out a mortgage, liability, and use your savings equity to cover the cost. The mortgage and your savings must add up to the price of the house. Understanding the balance sheet is crucial for investors. It helps you assess a company's financial strength, solvency, and risk level. By analyzing a balance sheet, you can gain valuable insights into how a company manages its resources, its debt levels, and its overall financial stability. This essay will guide you through the main components of a balance sheet and explain how to use this information to make informed investment decisions. Don't forget to subscribe to Declan Higgins' YouTube channel for more insights and tips on mastering balance sheets and other financial tools. Assets are the resources a company owns or controls that have future economic value. Think of assets as things that can generate revenue or be converted into cash. These assets are divided into two main categories: current assets and non-current assets. Current assets are short-term resources that a company expects to convert into cash or use up within 1 year. This category includes cash, accounts receivable, money owed by customers, and inventory, goods available for sale. Imagine a bakery. The cash in the register, the money owed by customers for cakes they've ordered, and the flour and sugar in the pantry are all current assets. Non-current assets, also known as long-term assets, are resources a company expects to hold for more than 1 year. These assets typically have a longer lifespan and are not easily converted to cash. Common examples include property, plant and equipment, PP&E, long-term investments, and intangible assets like patents and trademarks. For our bakery, the oven, the delivery van, and the secret recipe for their famous sourdough bread are all non-current assets. Analyzing a company's assets can provide valuable information about its operations and growth potential. For example, a growing company might have a significant portion of its assets in PP&E, indicating expansion plans. On the other hand, a company with a large amount of cash might be preparing for an acquisition or simply maintaining a conservative financial strategy. Liabilities represent a company's obligations to others. These are essentially debts or financial commitments that require the company to pay out cash or provide goods or services in the future. Like assets, liabilities are classified as either current or non-current based on their expected repayment timeframe. Current liabilities are short-term obligations due within 1 year. Common examples include accounts payable, money owed to suppliers, short-term loans, and accrued expenses, expenses incurred but not yet paid. For our bakery, the money owed to the flour supplier, the monthly payment on a short-term loan, and the unpaid utility bills are all considered current liabilities. Non-current liabilities or long-term liabilities are obligations due after 1 year. These typically involve larger sums of money and have a longer repayment period. This category includes long-term debt, such as mortgages and bonds, deferred revenue, payments received for goods or services not yet delivered, and pension obligations. The bakery's mortgage on its building and any outstanding loans taken out to purchase equipment are classified as non-current liabilities. Understanding a company's liabilities is crucial for assessing its financial risk. A high level of debt can indicate financial strain and increase the risk of default. However, some debt can be healthy for growth, especially if it's used to finance profitable investments. Section 4, Equity, the ownership stake. Equity represents the owner's stake in the company. It's the residual interest in the company's assets after deducting its liabilities. In simpler terms, it's the portion of the company's value that belongs to its shareholders. Equity is comprised of several components, including common stock, retained earnings, and additional paid-in capital. Common stock represents the initial investment made by shareholders when they purchase shares of the company. Retained earnings are the accumulated profits a company has earned over time and not distributed as dividends. Additional paid-in capital represents the amount shareholders have paid for shares above the stock's par value. Think of our bakery again. If the bakery's owners invested $50,000 to start the business, that's their common stock. If they've earned $20,000 in profit and kept it within the business, that's their retained earnings. and if they issued more shares to investors who paid a premium above the initial share price, that's their additional paid-in capital. Equity is a key indicator of a company's financial strength and stability. A healthy equity position provides a cushion for creditors and demonstrates the owner's commitment to the business. Investors often look at the debt-to-equity ratio, which compares a company's total debt to its equity, to assess its financial leverage and risk. Understanding how to use the balance sheet for investment decisions can significantly enhance your stock market strategies. If you found this video helpful, make sure to subscribe to Declan Higgins' YouTube channel. Click the subscribe button and turn on notifications to stay updated with the latest financial insights.